Are you unknowingly sabotaging your financial future by choosing the wrong dividend payout schedule? While most investors obsess over how much yield an ETF offers, far fewer stop to ask, how often should I get paid? And what does that frequency really cost me over time? The debate between monthly and quarterly dividend ETFs isn't just about convenience or cash flow timing. It's a decision that could mean the difference between retiring comfortably or falling tens of thousands short. High-yield monthly paying ETFs like JEPI, JEPQ, and SPHD often lure investors with the promise of consistent, paycheck-like income. But beneath the surface lies a dangerous trade-off: higher fees, limited growth potential, and increased exposure to market risk. On the flip side, quarterly stalwarts like SCHD, VYM, and VIG may seem slower and less exciting, but their focus on quality, dividend growth, and low cost can quietly build a larger, more resilient portfolio over time. This isn't just a debate about timing, it's about how your portfolio performs in real life, in real markets, over real decades. We're breaking down the myths, comparing performance, analyzing costs, and even projecting 30-year outcomes to reveal which approach is truly better for your unique financial goals. Whether you're looking to maximize monthly income, balance growth and stability, or build a bulletproof retirement plan, the choice between monthly and quarterly dividends is more than cosmetic. It's foundational. Get this wrong, and it could quietly drain tens of thousands from your future wealth. Get it right, and you unlock the full power of dividend investing. Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs, and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button, and don't forget to turn on the bell for updates on all our latest content. Dividend investing is often seen as one of the most reliable paths to wealth creation and passive income. But there's a critical choice many investors overlook: how often you get paid. At first glance, the decision between monthly and quarterly dividend ETFs might seem like a simple matter of cash flow preference. However, this decision runs much deeper and carries long-term consequences that can shape your investment outcomes for decades to come. In this comprehensive breakdown, we dive deep into the debate between monthly dividend ETFs like JEPI, GPQ, and SPHD versus quarterly dividend giants like SCHD, VYM, and VIG. Through a lens of total return, expense ratios, income consistency, and long-term growth, we'll explore what truly matters when building the ideal dividend portfolio. Understanding the core dilemma: timing versus growth potential. The primary difference between monthly and quarterly dividend-paying ETFs is, of course, the frequency of their distributions. Investors looking for consistent income, especially those in retirement or relying on their portfolios for monthly expenses, often gravitate toward monthly payers. These ETFs can simulate a paycheck-like flow, reducing the need for careful budgeting across months. On the other hand, quarterly dividend ETFs typically emphasize dividend growth, quality of holdings, and lower management costs. These are designed for compounding wealth over time and are often more tax-efficient for long-term investors. While monthly dividends offer immediate gratification, quarterly dividends tend to support stronger fundamentals and sustainability. This is where the conversation shifts from simple payout timing to a broader discussion of goals. Are you investing for income now or for total return over time? Among the popular monthly payers, JEPI, JEPQ, and SPHD stand out for their high yields and consistent distributions. These ETFs are engineered to deliver impressive monthly income streams, often appealing to investors seeking reliable cash flow. JEPI, for instance, has delivered yields in the 7 to 8% range by combining large-cap equities with covered call strategies. JEP takes a similar approach, but with a focus on NASDAQ-based assets, often yielding above 11%. SPHD leans more toward dividend-paying low-volatility stocks and offers a solid monthly income option with a slightly more conservative stance. These ETFs are often viewed as ideal for investors seeking income stability, especially those in retirement or aiming to supplement a pension or rental property income. However, these high yields come at a cost. Monthly dividend ETFs, especially those that rely on option strategies like JEPI and JEPQ, often carry higher expense ratios, which can silently eat away at returns. They may also limit upside growth, as covered call strategies cap potential gains. Additionally, these ETFs can be more vulnerable to market corrections, especially when the underlying assets are more volatile or when yields are artificially sustained through derivatives rather than organic earnings growth. In the short term, they may outperform due to high payouts, but over long time horizons, they may underdeliver when compared to their lower-cost, growth-focused counterparts. Quarterly payers like SCHD, VYM, and VIG have earned reputations for providing not just regular income, but also capital appreciation. These ETFs are typically built on portfolios of financially healthy, dividend-growing companies. SCHD in particular has become a favorite among long-term investors due to its blend of high-quality holdings, low expense ratio, 0.06%, and strong dividend growth. While the current yield of SCHD hovers around 4.1%, which is lower than JEPI or JEPQ, the long-term total return, a combination of price appreciation and dividend reinvestment, can easily surpass the monthly payers, especially over multi-decade horizons. These quarterly ETFs also benefit from lower costs, which may seem minor annually, but add up substantially over time. For instance, a side-by-side comparison of JEPC and SCHD shows that JEPQ's 0.35% expense ratio could cost you around $45,000 more on a $100,000 investment over 30 years when compared to SCHD's ultra-low 0.06%. This expense ratio trap becomes especially important in tax-deferred accounts like IRAs, where long-term compounding is the goal. The more you pay in fees, the less remains to be reinvested and compounded, directly impacting your future wealth. Moreover, quarterly dividend ETFs generally exhibit more stable performance during market downturns. Because they are composed of mature, dividend-growing companies, they tend to show more resilience in crashes or recessions. During turbulent times, these companies are less likely to cut dividends or go bankrupt, offering a level of psychological and financial security that high-yield, options-based ETFs often lack. While they may not offer as thrilling a yield up front, they provide reliability and durability, two traits highly valued in long-term portfolio construction. 30-year growth versus immediate income, what the case study reveals. Imagine investing $10,000 into both a monthly payer like JEPQ and a quarterly option like SCHD. At first, JEPQ's high yield and monthly checks may feel like a winning choice. Over the first few years, the income difference is notable, with JEPQ providing thousands more in distributions. However, this early advantage fades when you factor in reinvestment, fee drag, and compounding growth. Over a 30-year period, assuming historical performance holds, SCHD could actually overtake JEPQ in both total portfolio value and cumulative income generated, despite paying out less frequently and at a lower nominal yield. This case study highlights the deeper truth. Yield alone is not the best predictor of long-term success. The ability of an ETF to grow dividends, minimize costs, and perform reliably through market cycles often outweighs the appeal of high monthly payouts. It also illustrates the trade-off every dividend investor must confront, choosing between immediate income gratification and future income potential through compound growth. Crash-tested portfolios. Why stability beats frequency in a downturn. Market crashes and economic downturns serve as stress tests for any dividend portfolio. During such times, ETFs heavily reliant on risky strategies or leveraged income sources can suffer major drawdowns. In contrast, ETFs focused on dividend growth and quality often hold up better. Quarterly ETFs like SCHD and VIG invest in companies with long histories of increasing dividends, solid balance sheets, and recession-resilient business models. This makes them far more likely to maintain or even grow payouts during downturns, providing a reliable income source when it's needed most. On the other hand, ETFs like JEPQ or SPHD, which depend on yield-maximizing strategies, may see their income fluctuate or drop during corrections. Covered calls might underperform in a sharply declining market, and dividend cuts from underlying holdings can directly affect income distributions. In these scenarios, the consistent performance of quarterly payers provides a psychological edge as well. Knowing your income isn't at risk just because the market is volatile adds a layer of peace that's hard to put a price on. Strategizing for success, building your ideal dividend portfolio. Instead of picking sides, some investors choose to blend both monthly and quarterly dividend ETFs into a cohesive strategy. One popular method is the pure income strategy, where the primary focus is on generating the highest consistent monthly cash flow. This would lean heavily into ETFs like JEPI, JEPQ, and SPHD. It's ideal for retirees or those needing predictable income to cover living expenses. However, it comes with the trade-off of lower long-term growth and potential exposure to higher risk. A second approach is the growth income hybrid strategy, which combines both high-yield monthly payers and lower-yield, growth-focused quarterly ETFs. This offers a balance, steady income today with capital appreciation for the future. By allocating, for example, 60% to SCHD and 40% to JEPQ, you can enjoy meaningful cash flow without giving up too much growth potential. Finally, a smart solution is the dividend ladder approach. This method involves selecting a mix of ETFs with staggered payout schedules to create a reliable monthly income stream from quarterly paying funds. For example, combining SCHD, VYM, and VIG, each with different payout months, can result in a steady monthly income flow while maintaining exposure to high-quality, low-cost, and growth-oriented investments. This approach is ideal for investors who want the comfort of monthly income without compromising on long-term gains. Finding your dividend sweet spot. Choosing between monthly and quarterly dividend ETFs is not simply a matter of preference. It's a strategic decision that should align with your investment goals, timeline, and risk tolerance. Monthly payers like JEPI and JEPQ offer compelling yields and immediate income, but come with higher costs and more limited long-term growth. Quarterly payers like SCHD, VYM, and VIG provide lower upfront yields but greater stability, lower fees, and powerful compounding potential over time. Ultimately, the best strategy may lie not in choosing one over the other, but in understanding how they fit together. Monthly income can be comforting, but quarterly growth can be transformational. Whether you need income today, want to build wealth for tomorrow, or seek a blend of both, there's a dividend strategy that can be tailored to your needs. In the end, it's not just about how often you get paid, it's about how well your investments are working for you over time. Take the time to evaluate the long-term implications of your choices. A higher yield today might come at the cost of missed growth tomorrow, but with the right balance of payout frequency, yield, cost efficiency, and quality, your dividend portfolio can deliver lasting results. Choose wisely. Your financial future depends on it. Thank you for watching WealthEchelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.